If you have been led to believe that investment funds are magical wealth printing machines, we need to reset expectations immediately. A fund is simply a pooled vehicle where your money joins thousands of others to buy underlying assets. Success requires matching the internal mechanics of a specific fund to the exact date you need your capital. Think of the entire financial landscape as a spectrum. On one side, you have the speed at which you can get your cash back out. On the other, you have how aggressively that money can grow. Vehicles like ETFs, REITs, and money markets each live in very distinct, unyielding zones on this board. When you put money you need next year into a vehicle built for the next decade, you are vulnerable to bad timing. If the market crashes when your bill comes due, you are forced to sell your assets at a loss just to cover your immediate expenses. Selecting a mismatched vehicle creates a compounding friction that actively erodes your net worth through volatility or excessive fees. If you need your capital in under 2 years, your options narrow to one specific branch, the parking lot. The primary tool here is the money market fund. When you park cash in a money market, you are buying ultra-short-term government debt. In exchange, you get a yield around 3 to 5%, a stable net asset value of exactly $1 per share, and the ability to pull your money out the same day. But absolute safety carries a strict cost. Money market yields historically lag behind long-term inflation. If you leave your money parked here for decades, you will lose your purchasing power. If you want passive cash flow rather than absolute short-term safety, we look to the income generators, specifically bond funds and real estate investment trusts, or REITs. By allocating capital here, you gain access to corporate debt interest or commercial property rents without having to manage buildings yourself. These funds are legally required to distribute those profits, generating consistent yields between 4 and 10%. Cautionary, yield seekers must factor in the friction that regular income is usually taxed at your higher ordinary income rate, and the underlying prices of both bonds and REITs are highly sensitive to rising interest rates. That brings us to the most heavily marketed product in traditional finance, the actively managed mutual fund. This is where you pay a professional to handpick stocks on your behalf. The pitch is highly appealing. These managers sell the promise of outperforming the broader market by making targeted bets on specific sectors or spotting market trends before everyone else. The math tells a different story. These funds extract a management fee of 1 to 2% every single year. You pay that fee if the manager beats the market, and you pay that exact same fee if the manager loses half your money. This chart shows the diverging paths of investing $500 a month over a 30-year timeline. One portfolio pays a standard mutual fund fee of 1.5%. The other pays 0.05%. Over decades, that tiny percentage difference carves a massive, permanent hole in your net worth. As a mathematical rule, every 1% increase in fees reduces the total wealth you ultimately keep by roughly 20%. Paying premium fees for active management is a statistical trap. Over a 20-year span, the vast majority of active managers fail to beat the broader market. The superior counter-strategy relies on broad market index ETFs. Instead of paying a professional to guess which stocks will win, you set up automated monthly dollar cost averaging into a fund that simply buys the entire market. Historically, this captures an average annual return of 7 to 10%. By stripping out the manager, you strip out the cost. Index ETFs carry near zero expense ratios, often around 0.03%. This allows the mechanics of compounding to work entirely unimpeded. Bluntly, there is a psychological toll. To secure this growth, you must surrender control. When the market drops 30%, and it will, you have to endure the crash without panic selling. If your time horizon is 10 years or longer, ignoring the noise and automating your cash into a low-cost index ETF is the most reliable path to building millionaire status. You will also hear about the exclusive vehicles walled off for accredited investors, hedge funds, and private equity. These private pools of capital rely on aggressive mechanics to target absolute returns, using complex leverage, short selling against the market, and executing buyouts of private companies. The access fee is exorbitant. They operate on a 2 and 20 structure, taking a fixed 2% management fee plus 20% of all the profits generated, which aggressively eats into your potential upside. They also carry extreme liquidity risk. Your capital is often locked in a vault for 5 to 10 years, with a statistical probability of total loss if the underlying startups fail. Unless you have millions in liquid capital to risk and a decade of patience, these funds are an educational distraction. They are not a practical tool for the everyday investor. Fund investing follows two dominant variables: your time horizon and your expense ratio. We can map these vehicles into a straightforward matrix based entirely on your timeline. If you need your money in under 3 years, you are building the cash buffer. Stick strictly to money market funds and short-term bond ETFs. Keep this capital entirely out of the stock market. If you are looking for yield to fund retirement or generate passive cash flow, you are the income chaser. Use a mix of REITs and bond funds, but hold them in tax-advantaged accounts to shield that regular income. And if your time horizon is 10 years or longer, you are building the passive millionaire strategy. Decisively assign your capital to low-cost index ETFs like SPY or VTI. Set up your monthly deposits and do not touch them. Exchange the hope of quick returns for the high historical probability of a low-cost, timeline-matched portfolio. Let compounding do the heavy lifting and get on with your life.